Hi, it's Mark Item from Honu Trading with a market review on just another boring Monday, May 8th, 2023. First, a disclaimer, education only. Know your time frame and risk tolerance. Job one is always risk management. Follow me on Twitter at HonuMGMT at Honu Management. And if you find this valuable, take a moment to like and subscribe for more content. All right, here's what we'll talk about today. It's a tale of two markets. The biggies versus the little guys. We'll also talk about what happened in KRE, driven by Pac West cutting their dividend, that turning into a gap higher and trap lower. Then we'll take a little bit deeper dive. I'm going to take that chartered financial analyst rating out for a drive, and we'll look at the income statement and balance sheet of JP Morgan to look at what are a couple of big problems for the banks. And then finally, I want to introduce you to FinViz. This is a screener I use, and we're going to take a look at some new 52-week highs. So let's dive into the market. Another boring Monday. This was the fourth Monday where we've had a very small range, less than 2 points today. Now there is some good news. For now 6 weeks, we've been above the AVWAP from the all-time highs, and the moving averages. First of all, price is above that, and they're stacked in the correct order. The 8 above the 21, above the AVWAP, above the 50, above the 200, and we're also above the AVWAP from the lows. Still haven't been able to get through this 415 to 420 range. As I pointed out for a while, that's resistance going back over a year. The IWM mirror image. Price is below all the moving averages except the 21. 200, 50, 21, and 8. I'm sorry, we're over the 8, but below the 21. But from a bigger picture perspective, if we look at a weekly chart and zoom out, what had been resistance in 2018 and 2019 and even 20 before the COVID crash, once broken became support. And now that's been tested 1, 2, 3, 4, 5, 6 times. And the moving averages on a weekly, the 10 is below the 30, 30 is flat as a pancake for over 6 months, but the 10 is declining rapidly. And check out the volume. You'd expect it to be high back in the COVID crash, but it's been pretty high lately as well. So let's flip over to the banks and take a little bit deeper dive there. So here's KRE, the regional bank ETF. Silicon Valley Bank fails on the 9th. Plunges, stabilizes, all the moving averages stacked in the wrong way. We had a false breakdown below this in late April and then broke down for real last week. 2 significant drops, a rally on Friday, and then today gapped higher and almost had a completely bearish engulfing bar. And what drove that was Pac West. Now before the market opened, they announced they're going to cut their dividend from 24 cents to 1 cent to save cash that they don't need to pay in dividends that they may have to pay in either additional interest on deposits or is loss reserves on assets. So before the market, rockets higher, these are 10-minute bars. There's your pre-market low, and then when the market opens, in the first 10 minutes, that pre-market low gives way almost immediately, leading to a gap and trap. And we closed the day slightly up, about 3% up, but way off of the highs from earlier in the day. So we're not out of the woods on the bank yet. So now let's take a look at what's causing all the problems. And I'm going to preface this by saying everything I'm about to show you is already known, and what the market knows isn't necessarily worth knowing. But I'm going to show it anyway. So here's from Visual Capitalist today. This is the fastest that short-term interest rates have risen any time in recent history. So in 2022-23, we're up almost 5 full percentage points. Now for reference, I was a retail broker at Merrill in Alaska in 94-95, and the Greenspan Fed doubled short-term interest rates from 3% to 6%. 10-year Treasury went from 5 to 8. And remember that bond assets, it's kind of like a kid's teeter-totter. As interest rates rise, one end of the teeter-totter, bond values fall, the other end of the teeter-totter. So investors who spent years carefully crafting muni bond portfolios, CD ladders, and so on, as they suddenly were experiencing rapid 20-30% declines in their bond portfolio, they sold those quicker than you sold airline stocks in the COVID crash. So that's what's going on here. It's a bigger magnitude today, but taking a little bit longer time. There's something else I saw on Twitter today, and this, you'll see more of this in a minute. I already alluded to it, but JP Morgan currently has 2.4 trillion in deposits. Last year, they only paid about 10 billion in interest, or about 0.4%. It's kind of a blended rate. Apple's new savings account, 4.2. You'd have to work hard to find a money market fund that doesn't pay 4% or higher. Now, I don't know about you, but with the market being a hard penny environment, I've taken about half of our liquid assets and put them into money market funds yielding over 4% that I could turn into cash in one day. Now, if JP Morgan were to raise their interest rates, and there's no way they're going to raise them to 4.2 on the entire amount, but if they did, that's $100 billion, 10x on their interest rate expenses. So how are the large banks getting away from this? Let's take a look at the balance sheet. I told you I'd take that chartered financial analyst for a drive here. So here's an annual income statement. So last year, interest on deposits, they paid $10 billion. The total interest income was $92 billion. Their net interest income after loan losses was 60. So if they had to go and increase this from 10, not all the way to 100 billion, but to 40, that would cut their net interest income in half, all else being equal. Now, what's that going to do to their earnings per share? Well, they may buy back some stock, but they can't buy back that much. So that means interest rates and earnings per share are going to fall. How much? That remains to be seen. Again, the market already knows all this. So it's just a matter of watching it come to pass. So on the asset side, now securities held, now we're diving off into the weeds a bit. But after the great financial crisis, the Federal Accounting Standards Board, FASB, implemented a provision that if banks designated securities as held for investment as opposed to securities available for sale, that those did not need to be, quote, marked to market, unquote. In other words, unrealized losses could be, if you will, hidden. So from 21 to 22, it looks like JP Morgan shifted $100 billion into their held portfolio, and or they realized some losses on their available for sale. So as interest rates rise, bond values fall, maybe you don't have to realize the unrealized losses on these held for sale. But hey, the water's building up behind the levee and the pressure's getting higher. And at some point, something might break. And that leads us to this, another graphic I've seen recently. In 2008, Washington Mutual was the largest bank failure, and the next largest was 44 billion. So the three bank failures we've already realized, even the smallest is 2.5 times as big as the second biggest one from 2008. Okay, so that's the bad news. Now let's switch gears. I want to go over into FinViz and look at some new 52-week highs. Okay, so here we are, finviz.com, and this is the free version of the site. So I want to first start out with we're looking at the screener, and I've already built a bunch of filters in here. I want to show that. Again, this is all in the free part of the site. So you may want to choose something different, but I tend to be a little bit restrictive. As far as PE ratio, I want the company to be profitable. In a rising interest rate environment, that's not the time to be investing in companies that have, disruptive innovation, to quote the ARK funds. Maybe they've got great increases in sales, but if they're not profitable, that doesn't work in this kind of environment. I also want the price to be greater than 20. I want there to be a new 52-week high or low, and average volume over 500,000 shares. Additionally, I don't want any of those PacWest gap and traps. I want something to be up on the day from where it opened. So if I close up the filters, now we can look at a few charts, and there are only 11 new all-time, not all-time, but 52-week highs today. Eli Lilly, it's consolidating towards the upper end of that range in 430. It's had a big move already, but maybe it'll go a little from here. Nvidia has been up, it's been down, up and down, already trading at pretty rich valuations, but it's got that whole quote AI unquote thing going for it. A.G. Gallagher, insurance company, it was starting to move over the weekend. Of course, Berkshire Hathaway reported better than expected earnings. Maybe there's a little boost here. Builders First Source, now that had a gap on earnings, but this today gapping up to 113 and not really going anywhere. That might be an exhaustion gap. Fomento Económico de Mexicano, I don't know who they are, but you gotta love a Mexican brewer after Cinco de Mayo. General Mills, you don't want to see the consumer staples leading, and that has unfortunately been leading for a while. But that's offset by consumer discretionary and the home builders, the homies if you will. Pulte, higher, Taylor Morrison, higher, TriPoint, higher, and again, new 52-week highs all there. Another insurance company, Radian, and then finally a little guy, not even $1 billion in assets, a market cap rather, but LPG, which is a liquefied natural gas company. So those are what's going on with the new 52-week highs, and let's wrap it up. So we reviewed two markets. We looked at what's going on in the banks, took a little bit deeper dive, went down the rabbit hole a little bit. We looked at FinViz. So I'm going to wrap it up on my buddy Honu. Small losers win.